Boom. All right, guys. So tonight's class is an amazing one. It should tie it will, what we'll do tonight is begin to tie the concepts together. All right. So now we're getting to the actual strategy itself. This would be probably the meat of the meat and potatoes right here, right? Market structure, your key levels, and your time frame correlation. Okay. So I'm glad to have you guys. Yes, this is going to be recorded. But understand, guys, this is going to be a fairly deep class as far as getting you guys to understand what it is you're actually doing, right? So I'll break down each of the time frames, what chart they are, what it means. I actually add two indicators, okay, which is the MACD and the RSI. Now, these are indicators that help you determine the trend and a trend reversal. We'll get into that. I'll tell you how to use them and so forth, right? Like I said, I'm glad to have you guys. So let's hop right into this. Let me get this off of that. Oh man. No, come back. No, come back. Boom. Let me start this over. I had to get that thing off. It wouldn't show my my mouse. That's weird. All right, let's start this. Share you, get you off of that. Boom. Put you right there. Press play. Let's get it. All right, market structure, key levels, and time frame correlation. Huge, guys, right? So you guys heard me say market structure probably a few times by now, right? Now, all market structure is it's a support and resistance, but we define that though, guys, to a deeper level. Okay, we go a little bit deeper than just support and resistance, right? So previously we went over what support and resistance are. All right, so we'll go a little bit deeper to the concept and define market structure. Market structure is simply support and resistance on your charts, your swing highs and your swing lows that has produced a breakout or an Elliott Wave impulse. So the big moves or the consolidations or the pauses or the bounce or the breakthrough, like the horizontal lines we mark up on our charts, those are called breaks of structure, right? And those breaks of structure are more times than not, if it's a proper break of structure, happens with a huge trend move. And I'm gonna show you this stuff on the charts, guys, right? So these are your levels on your chart that attracts the most attention. Okay, so what we do is we combine candlestick patterns or price action with market structure, time frame correlation, fibs, etc., to build a list of confluence. Okay, and that's what confluence is. It's all those things combined that say, hey, the probability of this trade going in your favor is high, right? That's what confluence is. This is basically where we are looking to enter your trades for a strong price rejection after a strong price rejection. Okay, now, three things we look for at market structure or support and resistance, right? That has already previously produced a breakout. So what that sentence means is we're now at the retest of a previous breakout. Okay, so this would be quote unquote the second top of the M, right? Or the second top or the second bottom of a W. That picture it kind of like that right now. Okay, so what we're looking at is the retest to the same structure, which is some type of ABC correction. All right, while at that structure, and since we're recognizing this as an ABC correction, we're looking for rejection. And the rejection we're looking at is actually the price action of the candles. Rejection is the exhaustion of momentum. So for instance, if we're looking to buy at the second half of the W, we want to see these candles, those bearish red candles, produce wicks to the bottom and to begin making a higher low. Okay. Now, the third thing we do at these areas is we react. Okay, we enter off specific candlestick patterns after identifying the previous two, guys. And this actually ties into what Ryan teaches. The retest, rejection, react a little bit, all right? He might teach it a little bit differently, but I'm just trying to tie it all together, okay? Now, there are three types of market structure, okay? You've got your key levels, then you've got major structure, and then you've got minor structure, okay? Now, those three types of structure is what the three time frames are for. So the first thing that we do on a fresh chart, guys, is mark up our key levels. Now, the key levels, they're based off of a theory called the quarters theory, okay? And it says that the key levels are strong market structure areas on the monthly and weekly charts. The quarters theory is based on the premise that the daily fluctuations of currency exchange rates aren't random, okay? Previously, I said they were random, right? Yeah, this theory is based around that the price isn't random and that currency exchange rates fluctuate in an orderly manner between large quarter points within each 1,000 pip range, okay? That's for most pairs, and then around a 2,000 pip range for JPY pairs and some commodities, okay? Defined by two major whole numbers or swing points. So let's take a look at this image to the right, right? And this is why I kind of went into in depth as far as like counting pips, because this is how you count your pips, guys, right? So from a major whole number would be like $1.30 even at the bottom right hand corner of that image. That's a major whole number. So 1,000 pips on most pairs from that, you count up 10 cents. Okay, so you go from $1.30 up to $1.40. That's 1,000 pip range, guys, for most pairs. All right. If you cut that 130 and that 140 in half at the 135, that's the mid-range level. Okay. So the major whole numbers are my white hashed lines, the thick white hash lines that I have. And then my midway or my midpoint level is the red dotted line that I have. Okay, so my major whole number at 130 and 140 would have my my white hash lines, and then the 135 would have my red dotted lines. If that helps put an image to it, right? You guys have seen me drawing that before. But these are your key levels. All right, let's go on. So the quarter points, right? Now, the quarter points or the quarters theory focuses on 1,000 pip ranges. Hi, babe. 1,000 pip ranges between the swing low and the swing high whole numbers in currency exchange rates and divides these ranges into 4 equal parts called large quarters. All right. That's what the 1,000 pip range is called. That's a large quarter, right? So from 130 to 140 is a large quarter. Major large quarter points are known as the monthly key levels. That's what we mark up as the white hash lines. The major half point, which are also known as weekly mid-range, that is what we mark up as the red dotted line. If you cut those in half, that's what you get into the large quarter points, okay? And that's where the quarter or the 4, right? Quarter means 4 comes from. And that's what this image to the right is showing you guys. So you've got basically that 1,000 pip range cut into 4 different sections. We only focus on the major, okay? And the major half point, as these are usually areas of major structure. Now, the large quarter point and the quarter points, if you guys want to mark that up, be my guest. It won't hurt you. But we only focus on the major. Okay, so how do we use this to your advantage, right? So the quarter points, they serve as constant support and resistance levels, as well as familiar and variable price targets. So you have 2 things off of these levels already: possible entries and possible price targets, take profits, right? A bullish breakout above a quarter point is expected to target the next quarter point above, and a bearish breakout below a quarter point is likely to challenge the quarter point below. When a targeted quarter point is reached, the quarter is considered completed. If price fails to complete a quarter point, the unsuccessful completion of a quarter point usually causes a reversal that takes price back towards the preceding quarter point. Okay, and we'll go into a deeper study of this whole theory, or all the theories actually, after this course. All right, we're not going to do like a live session, but I'll release them as videos that you guys can study. So major structure, right? What is major structure in my eyes? So major structure, guys, would be like your swing points. You guys can clearly see highs and lows on the charts, right? From a trend, after a trend. That would be your major structure. That's the easiest structure to see, right? Major structure is the support or resistance that form the swing points, the higher highs or the higher lows, the lower highs and the lower lows. Those are your major structure areas. These areas produce the first move away from or form candlestick continuation patterns at support or resistance. These points are where we fib to measure the retracement against the previous trend as well. We look for this type of structure on the daily, the 4-hour, and the 1-hour charts. Those are our structure charts, okay? They set up the rest of the strategy. Once you find your structure chart using time frame correlation, you'll know what immediate chart to go to after you find your structure chart, basically. And let me send. Hold on, guys. All right. So these we look for the structure on the daily, the 4-hour, and the 1-hour charts, and these points take several candles to create. So a swing point takes a minimum of 3 candles, guys. So for a swing high or a swing low or a higher high or a higher low, there's a minimum of 3 candles that create that swing point. And I'll show you this on the chart as well. Minor structure. This is on the lower time frame swing points. Okay, so you've got major structure on the daily, 4-hour, or the 1-hour. The minor structure would be found on a lower time frame, on the time frames of either the 1-hour, the 30-minute, or the 15. All right. Now, going back into cycles within cycles, right? Minor structure would be the Elliott Wave cycle on a lower time frame. Okay, so when the minor structure from the lower time frame is met with the major structure on a higher time frame, that's a great opportunity for entry, guys. And that's just what the image to the right is showing you. To understand the difference between the structure points, we use a color code when charting on different time frames. Now, let's take a look at this Elliott Wave to the right. When I taught that session, guys, I always said cycles within cycles, okay? And this is showing you guys cycles within cycles. So in the red, you've got the major structure, the big wave, 1, 2, the red and black lines, right? The 1, 2, 3, 4, 5. That's major structure. So on a lower time frame, though, we should be able to identify the Elliott wave cycle that matches with that. So for instance, on the wave behind it, the hashed line, right? You see the 1, 2, 3, 4, 5 for wave 1 up, and then the ABC correction for the wave 2 down, for the major and the minor. Those two meet at a point, at some point, guys, and that is a great opportunity to get into the market. And we'll go deeper into this. I'm trying to kill you guys, man. I'm giving you all the sauce, bro. Listen, so you guys don't have to guess, though, as to what time frames to use. I lay it all out for you guys, right, in the triple screen method. So this isn't a created method or anything like that. Before I go on, I'm gonna look at this chat because I'm pretty sure there's some questions and things like that. But I'm trying to tell you guys, man, listen, I'm giving you guys the sauce, man. The sauce with an allergy. Let's see, minor structure is what I do a lot, but still primarily top-down analysis. Yeah, what I'm teaching you guys is top-down analysis, basically, right? In a different format, because a lot of people will, they'll use all the charts and all the time frames, guys. They're not going to show you the same stuff. One chart could be bullish, and the next one is going to be bearish, and so forth, right? So it's going to confuse you. I'm basically laying it all out. This is your all's foundation, okay? So understand that. If you deviate from this, guys, I can't help you too much. I can still help you, but not too much. I'm laying it literally out how I personally trade, guys, right? And like I said, modify it if you need to, but try to stay close to it. So let's keep going. So the triple screen, guys, this, like I said, you guys don't have to guess what charts to go to. I lay it all out, right? This method is actually found in the book Trading for a Living by Dr. Alexander Elder. It's like on page 153 and goes on for like 4 or 5 pages, guys. It's nothing special, it's nothing secretive, but I kind of modified it a little bit like that. In his book, he didn't really put a time frame necessarily with it, or a time frame correlation necessarily with it. This is my actual spin on it. He created this method and released it back in 1986. So it's been around for a little bit, right? This method applies 3 tests or 3 screens to every trade. Many trades that are attractive at first are rejected by one screen or another. So this time frame correlation, guys, like I said, I'm giving you guys the meat. This takes out a lot of the guessing for you, whether to go long, whether to go short, or whether to not trade. Okay. Gosh, dude, I'm so excited for this, guys. So like I said, for a new trader, guys, if you stick to this and have a good risk management, I swear to God, man, you'll be okay. But listen, this method applies three tests or screens to every trade, right? That many trades are attractive at first, but they're rejected by one or another screen. So trades that pass the triple screen, though, are much more likely to succeed, right? And so the 3 charts that we must identify, they are your structured chart. Then you have your entry setup chart. And then you finally have a candlestick entry chart, okay? Determining these charts will also help determine which type of trade that you're going to be speculating, okay? It's also going to help determine risk and reward parameters. So let's go over this chart to the right, okay? So you're starting with your first column where it says structure, okay? Underneath that, it says daily. So what this chart says, or how you read this chart, is if you find your structure on the daily chart, right? Your entry setup, where you actually look to enter or look for an area to enter based off of the previous structure of the chart, is the 1 hour chart, right? Your candlestick entry, once price reaches that entry area from the 1 hour, is on the 15-minute chart, okay? So if you enter in that trade, you're entering a position trade, which is an extremely long-term trade, or a swing trade, which is another long-term trade, right? So understand that those types of trade, guys, usually require about a 40 to 50 pip a stop loss. Okay, so you have to adjust the risk, your lot size on that, right? Use a smaller lot size. So down below daily, it says structure. If you find your structure on the 4 hour, guys, your entry setup charts, or the entry area where you find that area at, should come from the 30-minute. After price is in that area from the 30-minute chart, we're looking for a specific candlestick pattern on the 15-minute or the 5-minute chart. If we decide to take this trade, guys, this is going to be a swing trade or an intraday trade. It's going to be held for a minimum of 8 hours, right? So okay, but your risk management on this trade, you're not going to have such wide stop loss like you would on a position trade or a swing trade. You may, don't get me wrong, but if it's more on the intraday side, it's going to be a little bit narrower, right? And finally, if you find your structure, guys, on the 1 hour chart, and your entry setup chart is going to be the 15-minute chart. Your candlestick entry is going to be the 5 minute or the 1 minute. Okay. And honestly, even if you find structure on the daily chart, you could still break it down to the 5 minute and 1 minute chart using the same shit. This is the fucking sauce, guys. As I'm trying to tell you guys, it's retarded, right? So,
Hey, Core.
what's going on?
Hey, are you gonna give some examples of how these set up later on?
Oh, hell yeah.
All right, cool.
Hell yeah. So, time frame correlation, right? How do we color code for this shit? Like, how do we understand what we're actually looking at? And this is why I have color codes, right? This is why I've been using color codes, because different time frames take precedence over the one another, basically, right? The main tools we use when charting on TradingView, guys, we use the horizontal ray, the horizontal line, the trend line, a shadow box, and the Elliott Wave tools, which is the impulse wave of 1 through 5 and the correction phase of ABC, right? Each of these tools, guys, will have a different color depending on the time frame that they're used on. And of course, according to the chart at the right. So if I'm marking up anything on the monthly, guys, I don't care whether it's a trend line, I don't care if it's a shadow box, it's always with the color of white. So that way I understand what that is from a lower time frames perspective, right? Um, Again, the weekly is red, daily is orange, 4 hours purple, 1 hour is yellow, 30 minute is blue, 15 minute is pink, the 5 minutes green. And if you go lower than that, you can make up your own color. And honestly, if you want to change the colors on this, guys, it's perfectly fine with me. But understand what each of these colors mean, or you have to understand what you're setting the colors for, basically. So the first chart, okay, what does the first chart tell us, right, when we're looking for structure? I have an allergy. So the first chart is going to be your market structure and your trend. This is major market structure and trend, right? Here we want to understand the long-term trend of the market, guys. So we have to choose between the daily, the 4 hour, or the 1 hour. Now, whichever you choose, though, as your first favorite time frame, guys, is your intermediate time frame. Okay, we must examine one time frame above. So if you find structure on the daily, then you have to look at the weekly. If you find structure on the 4 hour, then you have to reference the daily. And if you find structure on the 1 hour, you have to reference the 4 hour. Okay, we have to reference them to see what the long-term trend is doing, right? And this is where we make a decision on whether the market is bullish or bearish. We also notate the following three things on our intermediate time frame. We want to notate their most recent break of structure using the horizontal ray tool. We want to find structure where we feel price should reach, or quote unquote some voids, right? Maybe, and we'll delineate that with another horizontal ray. And then we have to find structure that we feel the stop loss should be placed, or structure where if price breaks through, it could potentially continue in that direction, right? After we do that, we return to the intermediate time frame to begin. That's a typo. Oh shit. Yeah, that's a typo. All right. Now, on your first chart, guys, this is where we also introduce the MACD indicator. All right, so for you new guys, this is going to help you judge momentum of the market and look for divergence. All right, now what's the MACD look like? Excuse me, my nose is running. So this is the MACD indicator, guys. This isn't a price chart. This is the MACD indicator. So what we look for on the MACD indicator is, first of all, you see the number one where it says slope and cross of MAs. We want to pay attention to that. Are they sloped up, or are they, about to cross? Did they create that double bottom right there along with the divergence of the bars that said buy? There's a lot of things that go along with this MACD that helps you guys judge the momentum of the market, right? Up top, it says number two, the color and size of the red and green bars. The darker the green means the bulls have heavy momentum. The lighter the green means their bullish momentum is kind of drying up. It's the opposite for the bears. The darker the red, heavy bearish momentum. Lighter red means the bearish momentum is dying. Now, the third aspect of this is the shorter bar also means momentum is dying, whether versus a larger bar means that it's gaining. So if you look at the darker green, how the bars kind of grew in size, that means momentum is gaining, right? And if you look at the light green, where the bars kept getting shorter in size, that's also letting you know that, an aspect of momentum may be dying. Now, the MACD signals. This is a different look at a MACD, but again, let's pay attention to these bars. Those bars is what I want you to pay attention to right now. Excuse me. So the signals of the MACD. So we have to pay attention to the slope of the MACD histogram, and the MACD histogram is the bars themselves. That is defined by the relationship between the two latest bars. Okay. So if you're looking at at this picture to the far right, the last two bars on the MACD are in relation to the last two candle bars on the actual price chart. This indicator flashes a buy signal when its slope turns up and a sell signal when its slope turns down. The best buy signals occur when the MACD histogram turns up from below its center line. So if you're looking at this MACD, to the bottom right, you'll see some numbers that say like -20, -10, 0, 10, and 20, right to the far right, bottom right corner. The 0 would be like the center line, right? So if we see price crossing up above that center line, along with, not price, but if we see the histogram crossing up above that 0 and the price chart creating, let's say, like a double bottom, that's a good buy signal, right? The best sell signals are given when the slope turns down from above its center line. That's, for instance, looking at, well, D you got in a little bit earlier. So if we're looking at D, that would be like a sell signal with the histogram and price. That's a double top met with a lower bar. When the slope of the MACD histogram turns up, arrows A, C, and E, it allows us to trade only from the long side or standard side, actually. When that slope turns down, arrows B and D, it allows us to trade only from the short side or standard side. At the right edge of the chart, the uptrend is very strong because the signal E came from a bullish divergence, right? A double bottom of prices. That's what you see in indicators A and E, but on the price, that's your double bottom, right? And it was accompanied by a much shallower second bottom of the indicator. That's right where the circle E is looking at, right? So if we look at A here on the price chart and on the MACD, that low on the MACD is pretty significantly low, right? So after that low hit, though, we had that rally in price go up. All right. After price came up, there's always a retest to test an area as a support or a resistance. This time it tested as a support. That's what we're looking at over there at E. Okay, that's a double bottom or a W, right? Now, if we're looking at the MACD, the low MACD at A is significantly lower than the low on the MACD at E. Even though on price, they close relatively at the same price level. That's divergence, and we'll get deeper into that. Boom. Excuse me, guys. Sorry. Oh, that's disgusting. So divergence, guys, is you see the move before price shows the move. Okay. We'll get to this chart at the right. Divergence is the comparison of price action, which is what you see on the candles charts and the candle bars themselves, with an oscillator that tells trend or momentum, like the MACD and RSI, or the relative strength index. And these are the two indicators, guys, that we're going to add to help you guys, and it actually goes with this triple screen theory. So it's a low risk way to buy near the end of a downtrend or sell near the end of an uptrend, right? And there's two types of divergence. You've got regular, and then you've got hidden. But regular divergence comes in three types of signals. You've got strong, medium, and weak signals. And that's what this chart to the right shows you guys, right? So starting up top where it says strong on the left-hand side, bullish divergence would look like that. So you have the first low at the top of the red arrow, price bounced up, and then you have the second low. Yes, the second low came slightly below or lower than the first low, but if you look at the oscillator, which would be the MACD, you have a low and a higher low. I'm pretty sure you guys probably got some questions on this, and we'll get to that after I go over this chart. And the bearish divergence on a strong bearish divergence would be the exact opposite. You have a high and then possibly a higher high, but your MACD should show a high and a lower high in the histogram, in the bar charts themselves. Medium is when price is almost equal in closing. So that would be like a perfect W or a perfect M, right? And then weak, you definitely see that price is kind of like the strong, but look at the oscillator. That low, that second low on the bullish divergence for the buy signal is kind of next to the low, the first low that it created on the oscillator. It's kind of even, right? And then you've got, last but not least, hidden. Hidden divergence is where I would say this is probably going to be the last one that you guys pick up on, obviously, because it's hidden and it takes a moment for you to understand what's going on. So you will have price actually show you guys that it's on a bullish divergence. You will actually have price show you guys the higher low, but the second low on the oscillator will be actually a lower low. Okay, so they're kind of like opposite, right? And it's the exact opposite for the bearish. You'll have a lower high, but on your oscillator, you'll have it at the highest high. And that's hidden divergence. I'm gonna show you guys this on all the charts. So divergence, how do you use it? So just think higher highs and higher lows, guys, right? Price and momentum normally move hand in hand, like avocado and toast, Hansel and Gretel, Ryu and Ken, Batman and Robin, Jay-Z, Beyonce, Kobe, Shaq, Salt and Pepper. You got to get the picture, right? So if price is making higher highs, the oscillator should also be making higher highs. If price is making lower lows, the oscillator should be making lower lows. If they are not, that means price and the oscillator are diverging from each other. That's divergence, okay? Divergence trading is an awesome tool to have in your toolbox because divergences signal to you that something fishy is going on and that you should pay closer attention, right? Using divergence trading can be useful in spotting a weakening trend or reversal in momentum. Sometimes you can even use it as a signal for a trend continue, right? So, and this, guys, divergence is something that we're looking for on a first chart. Keep in mind, guys, this has everything to do with the first chart. This is regular and bullish divergence. Again, I go deeper into it, right? It's the same shit. If price is making lower lows, but the oscillator is making higher lows, that's considered regular bullish divergence. And that's the picture right here. Low, lower low, low, higher low. That's regular strong divergence, right? This normally occurs at the end of a downtrend. After establishing a second bottom, if the oscillator fails to make a new low, it is likely that price will rise, as price and momentum are normally expected to move in line with each other. Now, if price is making a higher high, but the oscillator is making a lower high, then you have regular bearish divergence. This type of divergence can be found in an uptrend. After price makes the second high, if the oscillator makes a lower high, then you can probably expect price to reverse and drop. The oscillators signal to us that momentum is starting to shift, and even though price has made a higher high or a lower low, chances are that it won't be sustained. Hidden bullish and bearish divergence. All right, so this is where I kind of get deeper into showing you guys what it is, right? Always remember, guys, that the trend is your friend. So whenever you can get a signal that the trend will continue, then good for you, right? But hidden bullish divergence happens when price is making a higher low, but the oscillator is showing a lower low. This is your top. This is your top picture. This can also be seen when the pair is in an uptrend. Price often makes a higher low, and then so look at this. Look and see if the oscillator does the same. If it doesn't, it makes a lower low. Then we've got some type of hidden divergence on our hands, right? Hidden bearish divergence occurs when price makes a lower high, but the oscillator is making a higher high. And this is where we, like I said, we read price action first before anything, but this is good to know. By now, you probably guessed that this occurs in a downtrend. When you see hidden bearish divergence, chances are that the pair will continue to shoot lower and continue in a downtrend. So a screen one review real quick. Screen one, guys, is our structure and our trend chart or our momentum chart. This is where we find or understand what is going on for the higher time frame of the trade we're taking, basically. So identify the trend using the following indicator and trade only in its direction, right? That is with the MACD. Trade in line with the momentum of the MACD and what price is showing you. A trader has three choices, basically to buy, sell, or stand aside. The first screen of this system takes away one of those options. It acts as a sensor who permits you to only buy or stand aside during major uptrends. It allows you to only sell or short or stand aside during major downtrends. You have to swim with the tide or stay out of the water. Okay, guys, this shit right here is amazing. It should take away a lot of guessing as far as what to do, right? So you have to attempt to locate on one of these three time frames: the most recent break of structure, an area to expect a retest. That's what the most recent break of structure is, right? You want to find structure price should reach. That's your area for potential take profit. Then you want to find structure in the opposite direction that price would need to break to continue in that direction. That's a potential stop loss area. If you're a trend follower, then you should, dedicate some time to spot some hidden divergence if you already know how to follow a trend. But if you do happen to spot it, it can help you jump in the trend early, right? So keep in mind that regular divergences are possible signals for trend reversals, while hidden divergences are trend continuation signals. Okay, again, regular divergences, those are your possible trend reversals. Hidden divergence is possible trend continuation. The second chart, this is amazing. The second chart, guys, is your entry setup based off structure from your first chart. So this chart is where you guys are looking at to see what area should be retested, right? And once it's retested, once price is in that area for retest, we go to a lower time frame. So again, this is the middle chart. This is where we want to look or find kind of like the retest. Entry setup based on structure. This is the second chart. This identifies the wave that goes against the trend. I repeat, this second chart identifies the wave that goes against the trend, right? So when the first chart when the first chart trend is up, the second chart's declines point to buying opportunities. When the first trend is down, the second chart rallies or bullish momentum point to shorting opportunities because they're rallying to retest structure that was broken from the previous chart, right? The second screen applies the relative strength index, okay? And this is applied in order to identify deviations from the trend. Oscillators give you buy signals when markets decline and sell signals when they rise. The second screen of this system, guys, allow you to take only these signals on this chart that puts you in gear or in alignment with the trend from the chart one. This is what I'm trying to tell you guys. We want to see the retest of structure from the first chart. And that happens, we see that happen on this second chart. And once we see that happen, we go to our lower time frame to react. Right? So how do we use the RSI? Or what is the RSI? The RSI, it measures any trading vehicle's strength by monitoring changes in its closing prices. It's a leading or a coincident indicator, meaning it doesn't lag too much like a moving average or most of your other indicators, which rely on a couple of different closing prices. This is going to go off whatever you set it up, right? So the RSI fluctuates between 0 and 100. Once it reaches a peak and turns down, it identifies a top. Okay, so if it's at the peak of in between 70 and 100, and you see price chart at some type of resistance, which is structure, right, or ceiling, which is structure, that's a good opportunity to enter at that top. I need an allergy pill. When when it falls and then turns up, it identifies a bottom. The pattern of the RSI peaks and valleys don't change in response to the width of time of its time window. So what that means is it doesn't matter how long that peak took to create. It doesn't matter how long that valley took to create, or the low, right?
Wallis, are you using your mouse?
No.
Okay. I just want to make sure. Someone was asking, they couldn't see your mouse, so I didn't know if you were using it or not.
Oh no, I'm not using it right now. Sorry.
They asked a while ago. I just wasn't sure if you were using it to like move around that graph or something. So just checking.
No, sir.
You want me to send you a pill?
Man, I promise you, I need some clarity or something, bro. I don't know what's going on with me.
I'll send one on the helicopter.
Oh man, that's good shit right there.
I'm drawing it to you.
There we go. Let me see. So the pattern of the RSI peaks or the highs and the valleys or the lows, they don't change in response to the width of its time window. The trading signals come more visible with shorter RSI, such as 7 or 9 days or periods. And we'll set this up, guys. So the RSI works well in trading ranges, but sometimes it will give you premature and dangerous signals when prices begin to trend. We only use this, guys, for our entry only, right? Just like we only use the MACD to understand our momentum and our trend strength only. Everything else comes from what is price showing us. So it calls for rallies when it rises above its lower reference line, which is marked by the 30 at the green arrows. So on the chart to the right, you see those green arrows. On the RSI, which is that indicator below, you see where it created like a valley or a low, right? On that 30 line. That coincides with the valley or a low on the price chart. So a very powerful sell signal is given by a bearish divergence of our RSI. Again, you got that word divergence. Yes, there's divergence with the RSI as well. So if you see divergence with the RSI on your price chart, on your entry setup chart, that should also go along with whatever you want to do from the previous chart. So the stock rallied to a new high while the RSI couldn't reach its upper reference line, pointing that rally's hidden weakness. The sharp break near the right edge pushes prices lower despite the RSI buy signal. To avoid getting hurt, we must use protective stops because the last trade in a range can easily create a loss when a new trend begins.
Hey, Wallis.
What's going on?
Timothy just asked if you could type the statement again about the RSI, MACD, and price action.
Ooh.
He just asked that. So, Timothy, what statement were you talking about? You can unmute yourself if you want.
Yeah.
Well, thank you. It was this little statement you said about the RSI is used for this, and you said the MACD is only for this, and we're only focusing on price action.
Yes. So The RSI is only used on your entry setup chart. That's the only chart that is used on. The MACD is only used on your structure setup chart. So MACD goes with your first chart, RSI goes with your second chart. That's it. After that, everything becomes price action. Well, it's already
MACD goes with, which chart is it? So RSI only used on entry setup chart and MACD used on what?
on your structure chart. So MACD goes with the first chart, RSI goes with the second.
See that? Thank you.
You're very welcome.
All right, I just put it in the chat.
Appreciate that, B.
Yes, sir.
Now, so the RSI
Awesome. Thank
trading
you, bro.
rules. You're welcome. The trading rules, guys. Here it is for you. The RSI is going to give you 3 types of trading signals, right? And here they are in order of importance. So, first of all, divergence is going to be the strongest type of signal you'll get from the RSI. Then you'll have the chart patterns, and then you have the level of the RSI. Now, again, you got bullish and bearish divergences, right? We went over divergences just previously. It's the same thing. Divergences between the RSI and prices tend to occur at important tops and bottoms. They show you when the trend is weak and ready to reverse. That's what the RSI shows you. It's a relative strength index. So if you see it at the top and price is showing you that, yo, it's exhausting, right? And we're looking at it at the retest. All of this, guys, is building your confluence. It's crazy. So you want to buy as soon as RSI turns up from its second bottom and place a protective stop below the latest minor price low. Buy signals are especially strong if the first RSI bottom is below its lower reference line, and the second bottom is above that line. Let's blow this up for you guys. Bearish divergences, they give sell signals. It's the exact opposite, guys, right? They occur when price rally is at a new peak, but RSI makes a lower top than during the previous rally. Sell short as soon as the RSI turns down from its second top, and place a protective stop loss above the latest minor high. Sell signals are especially strong if the RSI top is above its first top is above the upper reference line, while the second top is below it. What are the RSI charting patterns? Again, the RSI often breaks through support or resistance a few days ahead of prices, providing hints of likely trend changes. The RSI trend lines are usually broken 1 or 2 days before trend changes. So if you drew a trend line on the actual RSI and it broke, right? That trend line is broke. That's going to break before the price chart itself actually shows the move. When the RSI breaks above its downtrend line, place a buy order to buy above the latest price peak and catch the upside breakout. When the RSI breaks below the uptrend line, place an order to sell short below the latest price to catch a downside breakout. Now, the third charting pattern that we're looking for is the RSI levels, the numbers on the RSI themselves. So when the RSI rises above its first upper reference line, more times than not, traders have this set anywhere between 80 and 100. So when it breaks above the 80 to 100 line, then it shows that bulls are strong, but the market is overbought and maybe possibly entering a sell zone. So when the RSI declines below its reference line, it shows that bears are strong, but the market is oversold and entering its buy zone. So the lower reference line is typically around in between 30 and 0. It pays to buy using overbought signals, okay, of the RSI when the weekly, pay attention to that. Oh my God, that's a typo. So it pays to buy using the overbought signals from the entry chart's RSI when your first chart's trend is up, right? It pays to sell short when the sell signals from the first chart when, oh my God, that's a whole typo. Okay, yeah. So it pays to buy when the overbought signals of the RSI when the first chart's trend is up. So on your entry chart, when the And when it's saying it's overbought, but the weekly trend is up, it pays to buy. Okay, because again, you're looking at the RSI. Previously, it just said when RSI enters or is above that top line, the bulls are in strong control. So if the bulls are still in strong control, plus the first chart's telling you the trend is up, that's a continuation signal. All right, and it's the exact opposite for the short. If it's below that 30 to 0 reference line, and your first chart still telling you to sell, that's a trend continuation for a sell signal. See chapter 39. Yes. All right. So your entry setup chart. Here's your review, guys, right? So your first chart is your structure chart. It's either coming from the daily, the 4 hour, or the 1 hour. After you identified your structure chart, you have an immediate entry setup chart to look at. If it's the daily, it's on the 1 hour. If it's on the 4 hours to 30 minute. If it's on the 1 hour to 15, right? So we identify the wave or move against the previous chart. So if the daily is a buy, we want to see the 1 hour pushing, completing, or doing the retracement, going against that buy. Okay. We want this chart to complete a retracement and retest to chart 1 structure. This is why we mark up the most recent break of structure on chart 1, because that structure has to be retested. We use the RSI or any other oscillator that you may be familiar with, basically to look for divergence and any other signal that will be in a line with the first chart's trend. And then, of course, after this, we go to our candlestick entry chart, which is continue to use time frame correlation. Check this chat real quick before I go on. Ooh, cheat sheet. Not ready for that just yet. That cheat sheet, guys, is fire. It's going to make an
I'm ready for it.
It's going to make an aha moment for you, I promise you.
Yeah.
All right, cool. Chat is clean. Now, these last two, this is wrapping it up for right now, right? So the candlestick entry chart, which is the third and final chart that we look for, right? So by now we have defined our structure chart and an entry setup chart. Now we have to look for an entry based off price action alone of the candles, right? We've got a little bit of wiggle room in this chart as we can use lower time frames for precision and adjusting any stop loss for a better risk to reward ratio. Now, on this chart, guys, we want to see price at the structure area, at structure from the first chart and second charts with a shift of momentum present and a break of structure in favor of the trend of line 1. So let me break this down. If the chart to the right breaks it down. So if your structure chart or your trend chart is bullish or long, right? If your entry setup chart is also bullish or long, right? Your action as new traders is to stand aside, not to trade it. If your structure chart is bullish, your entry setup chart is bearish, we want to be looking for a buy order. So there's two types of orders that we can enter, either a buy limit at a fib entry zone or a buy stop at the high. If the structure trend is bearish or a sell, and your entry setup trend is also bearish or looking like it's a sell, guys, stand aside, don't trade it. If the structure trend is bearish, but your entry setup trend is bullish, we're looking for shorts. We're looking for an entry zone to sell at. This is where we use our sell limits at the fib entry zone or a sell stop below the low. Guys, I'm giving you all the sauce, man. I pretty much took out all guessing that you guys as new traders do. Like, what do I do in this instance? What do I do in that instance, right? This is what this fucking system gives you. It takes away all of that. I'm telling you what to do in all of those instances. If you don't see anything like that, guys, you sit on your hands, okay? Now, to go deeper into that, when you are ready to enter, right, we also want to see either an engulfing or a Maribozu candle. More times than not, guys, it's going to be an engulfing candle. If you see that candle, guys, take the damn trade. We also want to look for any kind of candle reversal patterns that we're comfortable with trading and can easily identify, right? So don't just let the engulfing. I will say start with the engulfing because that's going to be the most consistent one that's going to win for you guys. All right. Now, while it's structured, we want to begin to see signs that the trend is either reversing to follow the trend from the first chart, or signs of the trend continuing, still following the trend from the first chart. Right? That's all. Now, take a picture. This is the cheat sheet, guys. This is shit, man. I don't know how y'all like y'all nuggets sauce.
Screenshot, hashtag screenshot.
Let me break this down for you guys.
Hey, I screenshot it, Tommy, put it up.
Straight up, like I'm trying to tell you guys, this is the system, right? Of course, you guys see that those lines. What does that look like? Elliott Wave, right? Now, on this here image, I'm going to break it down to you, okay? The light blue line, that's going to be your structure chart, okay? So you identify the trend, right, on your structure chart, what's going to happen, okay? Now, using this picture, that looks like a nice impulse wave up and a retracement that is looking to complete. So we're looking for our buy signal, right? Now, since we found our structure chart, we go now into our entry setup chart. The entry setup chart on this picture is the light green line. Notice what happens with the light green line. It completes your waves 1 through 5 up to the highest high of the structure chart, and it completes your ABC correction to the lowest low of your structure chart. Those two meet up. Now, you also have a black squiggly line on this, right? Which will be your candlestick entry chart. Look how all of this shit aligns. I kid you not, guys. This is what you're learning. When those three things align, guys, bro, it's like fucking magic. It's crazy. But this is the cheat sheet, guys, like to understanding this system. So those three lines are telling you 3 different time frames. They're also telling you your structure chart, your entry setup chart, and your candlestick entry chart. Each of those time frames have an Elliott wave cycle running on it. That's what I mean by cycle within cycles. And I think that's all I have.
It's that inception, boy. That inception.
Together on Thursday. Now, before I go to the charts, I'm going to let you guys ask any kind of questions. Like if you guys don't understand it all or begin to get like a click by that, you know, ask the questions now.
It started clicking last call. This call definitely put everything together. Now I can set my trades and go to sleep.
I'm trying to tell you. I'm trying to tell you, bro. Listen.
Learned something new today, huh, Paul? Yeah, and I was watching while I was driving home, but it's like, damn, like,
it makes
between
sense.
Last week and this week, man, there's too many clicks that happen.
I told you guys, this would be the class that would make a lot of people, you know, click some kind of aha moment. Because listen, this was the meat, guys. This is the meat right here. So I don't care how many times you have to watch this video, but guys, if you guys pick out your 3 charts and follow the shit that's aligned with those, bro, there should be no guessing in what trade you should be taking, basically. None whatsoever.
Saucy sauce.
Super sauce, bro. Like this is crazy.
Can I see an example? You putting it all together?
Yeah, I'm gonna walk through the charts and put it all together for you, bro. Like
Yeah.
I just wanted to have any kind of chance to ask any kind of questions first.
Definitely as a beginner, like it definitely makes a lot of sense, but it's just that I want to kind of see it because like I'm definitely a slow learner. It makes sense now until like I have to do it by myself, and I'm just like,
Oh yeah, it's gonna take you guys some time, man.
Yeah, we'll definitely get you there, Tim, for sure.
No, I agree. You just got to look at all the charts and put in perspective. But I think the breakdown's easier to understand than if you're starting out there blind, honestly.
Yeah, no doubt.
totally agree. I did have a question though, but it's more of like, do you generally, like how you're feeling, do you generally like to scalp and then you're feeling like, you know what, I'm going to take it easy for a little bit and I'm going to start probably doing a swing trade for about like an 8-hour, 10-hour range? Or do
Man,
you be like, I only trade these hours always to keep your system up?
I trade specific hours of the day only, and I trade the setup. I let the system determine what type of trade I'm entering. I trade the setup.
Okay,
Hon-
that makes it very clear.
Honestly, you're really trading price and time whenever it
Yeah.
lines up.
Yeah,
Honestly.
Yeah, exactly.
pretty much. Yeah, because when you find the setup, you already know where you think like I'm kind of like Wallis. I do a set it and forget it type of thing and just let a trade play out. And when you do that, you already know where you think the market's going to go, whether it goes against you or for you. So you already have your take profits, everything set in. So it really just is based on how long it takes for it to reach your take profit. Right, Wallis? It's really just how long it takes for it to hit your take profit or your stop loss when you do a set it forget it type thing.
More times than not, like it's starting out, we're teaching you guys to catch 20 to 30 pips. Right?
Yeah.
So that way you grow your account. More times than not, that should be within that day, within a 24-hour period, I would say. Unless it like enters in consolidation, then yeah. Like if you enter, like for instance, if I entered in tonight, I would expect some type of profit by New York, unless the market is just consolidating.
Yeah.
So let me find a pair that I haven't marked up.
I say something, man. You really lost me on all that. I gotta listen to that again on my own, some rewinds and
that's why they're recorded, man.
Yes.
yeah.
I can't tell you how long. Yeah, I can't tell you how many times I've had to go back and watch recordings of stuff over and over.
Once you see it on the charts, it'll look a little different too.
Yeah, it'll look way different.
Yeah, hopefully, man, because there's a point where I just got lost and I was
Look,
trying to backtrack myself and trying to listen and it wasn't clicking.
Reading a paragraph and seeing on a chart are two different things.
Yes, 100%.
Exactly.
All right, so here I go, guys. I'm about to walk you guys through.
You gotta share your screen.
The whole thing.
Oh, there we go.
So this is Euro GBP. It's not marked up. This is a fresh, clean chart, right? So here's how I approach it. Like I'm just going to go to step one, guys, mark up your key levels. All right. Always mark up your areas of structure first, like your key levels first, right? Use that with the horizontal line tool, actually. And again, since this is the monthly chart, it's got a template already set for it. Now, how do you, let me mute everybody real quick.
Yeah.
Now, how do you identify these key levels? Again, guys, it's already kind of predetermined for you, right? Using nice round whole numbers, first of all. A deeper look inside the key levels. More times than not, guys, you can start from, if you're lost, start from $1 even. Okay, everything always reverts back to $1. 1,000 pips up from $1 is what? 10 cents. So you're now at $1.10 and go about it that way, right? I automatically see this 70 right here. This 70 cents, 70 from 60 would be 1,000 pips, right? So I'm going to delineate that. And guys, when I put these tools on the monthly charts, those drawing tools, I'm using precise charting or precise price. I want it to be exactly on there. So from 70 going up 1,000 pips, 80 cents, right? So what I want you guys to pay attention to while I'm putting these on here, though, I want you guys to be paying attention to how the candle's actually reacting to that price, right? I can't make this shit up, guys. I'm not teaching you guys anything that's hasn't been out for a little bit. Like, so, boom. Look how price is reacting. I didn't look at price to set that, right? I looked at the quarters theory. I used the quarters theory. And sure enough, here's a break through that level, pin to it, resistance. I can't make this up. So at an 80, right, you go up to 90. And again, I'm using precise price. Nice round hole numbers. I can't make this up. Look at this. Look how price reacts to these levels, guys. And this is why when price is at these levels, it's good to be paying attention to your price charts to see if you can either A, continue the trend if price tells you that, or B, look for rejection or exhaustion.
Yeah, you can see the one candle go to the left with the breakout on. No, go more to your left. Keep on going. To that green candle that breaked out like in the middle.
Oh, right here?
Yeah. No. Before that, bigger. Let me see where it's at.
This
Right there. Yeah, they created a void where you can see on the right hand side. It created a resistance where it bounced off, and it went right up to that top level.
Yep. Bro,
Yes,
it's
sir.
crazy. Shit's crazy, man. So we cut these levels. We usually want to create 3 zones. So this right here would be 1 zone. This is the 2nd zone. I'm actually going to go up to $1 just because I like.
Active candles. Gotta love them.
Hell yeah, man. Boom. Boom, boom, boom. Dollar even. Cool. You can't really see it, but it's good to have on there. Now, what we do now is we mark off the midpoints. In between 70 and 80 is 75, right? I've got a template set up for it. Midpoint. Just put it at the 75. And guys, once you have these marked up on your price charts, you more times than not, guys, don't have to move them or redraw them unless price has broken up or broken below the most bottom point or the most top point. They just stand true time and time again. Let's see. So
as long as they're bouncing within those quarters.
Right. 85. Boom. Again, guys, pay attention to how price is reacting to these price levels. Like, I can't make this shit up. It's just pretty cool. And we'll use 95. Boom. That's a pin to it, right? Look at this. Amazing, right? That's all I pretty much do on the monthly chart, guys. Mark up my key levels like that. Now I'm looking for, now I'm going to go to the actual system, my time frame correlation. So I have to pick out my structure chart now, right? So to do that, I'm looking at the daily, the 4-hour, and the 1-hour charts. And the structure I'm looking at, or I'm looking for, is the most recent break of structure. And can I enter into a trend immediately, right? Or can I enter immediately? Now, looking at this already.
It's hard for me to chew it. I know it's hard for me to chew it.
Maybe you want to mute yourself?
Put it down.
I got it. Now, looking at this already, guys, we see this inside return. What are we expecting? A, B, C. What structure was broken by this trend? This structure right here. What is this? The retest, right? So that's what we're looking for. So we see this change of momentum, this retest to the bottom of this structure to create this ABC. Let me draw this out for you guys. Right? ABC. This is the long-term trend that I'm drawing out, guys. Remember, this is the long-term trend. So we know that this is just an ABC correction. We expect it to come all the way down here, but if it finds support with this low, hey, that was just an ABC right here. This will be like a W, a double bottom right here to go back long, right? So we have to understand that we're in a counter trend trade. This being the trend, this being the counter trend, right? Now, this is, I'm looking at this way before my MACD. Notice that, okay? Also, before I even do that, I can honestly mark up everything on here, any kind of structure that I see from the daily chart. So we see this pin. I'm looking at the macro view, right? We see this pin up, came down. Now we see this move right here. This would be an A, B, C move up to test this, but this is the ABC correction of this move. This is structure, guys, right here. what we're currently at. I want to make note of that. I don't want that to be dotted. I want that to be.
Why did you choose that area?
Great question. I was waiting for somebody. So,
Love it.
This is what I've been waiting for.
correct. Now, what
I'm glad
made,
you asked the question.
what made me
That was
choose
supposed
that
to
is I'm pretty keen at with looking for breaks of structure. Okay, now let me define to you guys or show you guys what a perfect break of structure is. Right. So we see this inside return right here to this trend. Right. We see this bullish candle right here. Okay. This bullish candle came up but failed to break this high. So in fact, this is a lower high than this. So this low has to be broken. This would be the structure. Now, what looks like a perfect break of structure is it takes 3 candles, a minimum of 3 candles, guys, to signify a perfect break of structure. You want a minimum of 2 of those candles to have full bodies or large bodies in the direction or in the trend of the break. So let's look at that. You've got this candle that actually closed. Even though it closed, it doesn't look like it did in fact close beneath this orange line, which delineates that structure break. That's your first break. Your second candle is a spinning top, okay? That spinning top, yeah, it came up here to retest something, but it did what? It actually made a lower low and closed below that structure. Your third candle also did a test and did a full body candle with some type of momentum, right? In the same direction of the break. This candle pattern right here, these 3 candles, I'm about to point them out to you on every break of structure, and you become familiar with it, right? Whether this candle looks like that or not, become familiar with this, right? Let's look at it.
Yeah, Corey.
What's going on?
Just to so for the higher lows and higher highs and whatever.
Yeah.
That's I guess a dumb question. Are you counting the wicks? Like say,
I am.
like are you say yeah? I'm saying like yeah. Say you're getting like a higher high, and
Right.
say the body wasn't as like I guess big as the previous one, but the wick went up to make a new high.
Like this?
Is that still yeah?
That is in fact the high. The
Like it
tip
broke the previous high. Yeah.
Yeah, it broke and extended the high. Don't get me wrong, but
Okay.
it closed lower.
Gotcha.
So like for instance, this one right here, like yeah, this wick right here, it came up and tested some type of structure actually with the close of those candles, right? The open close of that candles, and came back down. It even opened up lower than this candle. But yeah, I'll go off wicks.
I have a quick question.
Yes, sir.
Why?
So when I see you do your
Please?
structure, I like to do the high, the structure,
listening.
and the lowest low. So it's like just to kind of give me a little bit of a bounce to see.
Yeah.
Is that necessary, or you just like no? Would you rather just say just do structure only?
No. I'm going to say do whatever works for you. Okay.
Okay, I was just saying like
do what works for you in that instinct.
okay, but just make sure I know what structure is.
Correct.
And I should be good. Okay, just wondering.
Correct.
Thank you.
You're very welcome. So this 3 candle break of structure, right, is what I've seen. And if we look at to the right, here's a test. Here's a break through it, right?
Oh no, I'm being annoying right now.
Hey, Matt, mute yourself.
There he goes. Here's a break through it, but it's not a complete break of structure. It's not a perfect break of structure. Let's see. If we look at this pattern right here, that's a break of structure. And the structure that was broken, let's see. I can drag this all the way over. You see this old highs? Old highs become, old resistance become new support, right? Or they become still a resistance to a certain degree. Break of structure, but here's another break of structure. So guys, what I need you guys to notice is typically when you see like the vector candles or candles with huge bodies like this or a trending market, it broke through some type of structure, right? For instance, the high right here, this candle, huge candle that broke it, right? Retest to it, bounce, but the bounce didn't have any momentum in comparison to this, right? This is what we have to pay attention to. So also we know this is an inside return. Also, since this is an inside return, we should expect some type of ABC correction. We see this first move right here is A. This move is B. Now we look for the retest of this low or this structure for the C completion. More times than not, going back to the Elliott Wave class, wave C is a move of a heavy trend. It probably will complete like a 1, 2, 3, 4, 5 Elliott wave to some degree on a lower time frame, right? But just notice like what happens when what a break of structure candle looks like. It's these big ass candles, guys. This right here, 1, 2, 3, is another perfect break of structure example. Boom. These is the structure. The high is the structure. Candle closed above it. First candle, second candle, kind of like a smaller spinning top candle, but this is actually a hammer. Boom, right? That's your break of structure, guys. And if you guys don't understand or pick up on this just yet, as you guys rewatch this video, I kid you not, you'll train your eyes to look at breaks of structure a little bit differently.
Yep.
Quick question, if you don't mind.
Yes, sir.
So I'm looking in from the AB. So with that, with the 3 red candles going down, would that be the 3 soldiers, the 3 falling soldiers into a green 3? Was it like a 3?
Oh, right here?
Well, yeah.
Well, I would say so.
I'm saying so is that a false breakout into an exhaustion?
This you can look at it like that. I would say you could look at it like that because you have to understand like this is the main trend, right? If somebody looked at this and seen this, they would be like, okay, yeah, it's going short now, right? So they'll enter on this short, but you have to understand that the retest always is some type of structure that was broken. Whenever you see these moves like this, guys, some type of structure was broken, whether it's major or minor, okay? Now, 3 right Russian reversal, that's your A move. This B move is trending, but it's not really big ass candles like this move right here, right? Bears are still in control. So now we're at this structure point, which is a crucial area to be in. Also, if I pull up my fibs, oh man.
Let me some fibs.
What area are you in, guys? You're at the 618 at this candle already.
Boom.
This is her entry zone, right? Our take profits, where are our take profits at, right? They're with structure where we expect C to be at. We haven't even entered yet. So I haven't even shown you all the MACDs. So like I could be wrong. You never know. But let's take a look. Oh, what do these bars right here? What is this histogram showing us, guys?
Yeah. What's the word?
A weak,
What's the word?
a weak bullish movement. It's slowing momentum down.
What did price show us though, guys? What did price already show us though, guys? The bulls had already not really been in too much control in relationship to this previous move, right? They definitely weren't in control like this. Look at this move on the histogram compared to this move on the histogram, right? It's already making the lower lows on the bars for you. I mean, the lower highs on the bars for you. Price is already exhausting for you guys. It took 1, 2, 3, 4 days to gain back this one day. That screams exhaustion of bull, right? So we're looking for this candle. Or we can go to a lower time frame. So since we've seen this structure on the hour time frame, right?
Daily.
I mean the daily time frame, right? That chart I showed you guys says my entry setup should be from the 1 hour. Now, let me finish marking this up for you guys. I deleted my shit.
Do you go from wick to wick with the fibs, or do you go from body to body?
Wick to wick.
Yeah. Some people do body to body.
Yeah, what's the difference? What does it? Is it that much of a different
As long
response?
as you don't flip flop. Like if you sometimes you do wicks, sometimes you always want your analysis to be the same. But honestly, most people do wicks. I do wicks. You know, Wallis does, Caesar does, Ryan does. Some people, like I've heard Ryan talk about it too. It's just some people.
Ryan does. He goes body to body.
Does he? Okay.
Mm-hmm.
Yeah, I do wicks too, because that is still movement of price action.
Right. The price still went there, right?
Yes, but again, if you do body to body and it works for you, that's fine. It's what works for you, you know.
Well, I started out with wick to wick, but then
Woo. Saucy.
Yeah. Let me see. Let me get this indicator on here. Hold on.
All this extra sauce with DX.
Why?
that's right. Come through.
Okay, so now we're not going to there. We'll take that off. So we're on our entry chart, right? This is the RSI down here, guys. Right now it's set at 14. I'm going to adjust that to like probably a 9. I think I like the 9s on this. Boom. Cool. These are the levels they're talking about. Your upper level, your lower level. Get off of there. Right? Now, here's what we want to see. Okay? Let's go back to the daily chart. Our daily chart looks to be at what, guys? A possible higher low than this one. Okay? Not only that, it already pinned kind of our entry zone off the 618. Now we're looking at our entry setup chart. Okay? Here's the pin into our entry. But I want to expect one more push up before a push comes down. Only because this was a pin and not really a nice run like this. So I expect another run that will fail above the high of this wick, basically. If it closes above the high of that wick, I have to see it immediately slam right back down into that same zone. If not, we're probably looking at some more bullish continuation, right? But hell, it could even not even go up there. It could just go short. Long story short, our daily, let's not look at that RSI, but our daily is showing, hey, we need to complete this C wave down. We definitely have to complete or retest this area down here, this bounce. So it's telling us short. And we already seen on the MACD that the bullish momentum was basically dying, right? Since that says short, we wanted to see our entry chart be what? Bullish, guys. This is what we wanted to see on our entry chart. We want it to be bullish. Now, here's where we fit from.
Hey, where'd you get that RSI indicator from?
So up here in indicators.
Yeah.
Once you hit indicators, just type in RSI, and it's relative strength index.
Oh, okay.
And you keep it at 70-30?
I keep it at 70.
No.
You can adjust it to 20/80 if you want to.
Some people do 80/20. Yeah.
Yeah.
Huh. I was taught that at 60-40, but I never really understood how to use it.
Well, now you know.
I'm learning.
That's good. I'm glad you learned it, man.
What are the differences in those settings, though?
It's
like
just,
60-40, 80-20?
I would say the strength of the signal that it provides. So like if you used 80/20 and you see the RSI cross above or below that line, and you see it like the next couple of candles cross back down beneath it, that's a pretty good signal for like, you know, a sell or a buy.
Huh.
Now, so what I did, guys, is delineate more structure, okay? So what I was actually thinking was I was going to fib from this high to this low, because this is the structure I delineated. I want to get this whole move to see what type of retracement against it this is. And sure enough, what happened? Now we've got some more confidence. 618, and it actually pinned up to our 786, right? Right. Now,
Wow.
here's
Can't
another.
make this shit up.
I swear, bro, I can't make this shit up. Like, I'm just giving you guys technicals, right? Straight technicals and price action. Nothing too fancy. So this right here, there's a few things that you can do to it. You can draw up your trend lines if you want to. Which one do I want to use? Tricky trick. I'm gonna use this one, and I'm gonna do it like this to show you guys like a trend line break, retest, another trend line break. So, which is what we want to see. Now, this is when I haven't taught you guys the timing of this shit yet, but understand I look for these setups for specific reasons at specific times. So, what I expect in between the time of, I would say 10:30 and London Open, we want to see that false move, right? Or that, what do we call it? That stop hunt, whatever you call it, guys. We want to see that final push up that fails, still below this top structure line, still below the top of this wick, or even below this high right here. You name it, right? Or what we could see is price break down below it, and then come London, come up and retest the bottom of the structure right here that it would break through before going short again. Long story short, guys, we're looking for a short type of situation, right? It's just not there yet. Now, here's how I would play this out. Let me see. I want to delineate possible outcomes, right? So I've got this right there.
Corey, what are your few favorite pairs that you trade?
Yeah, that's a good question. Here's my list right here, guys.
All of them.
Yeah, I mean, well, it's not. It's just all of the majors.
All the majors. Yeah, all the good ones.
Yeah, all the good ones.
Yep.
Nothing fancy. So the reason why I marked these two yellow lines up here is because they're actually extensions. They're Fibonacci extensions of this retracement right here. So let's say this was a move and this actually just retraced, right? And bounced up right here. This would be a first possible take profit. This would be a second possible take profit. But they're not necessarily take profits. For me, they're possible entries for the longer term of the major trend. Because look what zone they are still in, guys. They are in the zone from the daily chart, right? And this is why it's good to know what type of structure you're looking at, what everything is, because you can also play out the different possible scenarios. So that way you're prepared. Now, I have to see, before I can give you guys any type of entry on this one, like I said, I've got to see a push up that fails. I'm expecting it, like I said, to push up and still fail below this first high right here and then going short. It's just not time for me to look at the chart just yet. So once I had seen price, let's say, do a bull run, which is what we want to do. All of this is a bull run. We want to see it do one more bull run that fails. And honestly, like I said, this could have been that bull run because here's a push, another push, pin up push, and that last push still closed lower than this high. And this is why I go off the wicks. This is a higher close than all of this, yes. But remember, price did at one fact, guys, come up here, which is why it's painted, right? It just didn't close up here. And that's why a lot of the times I go off the wick. Now,
Well, it closed on a lower time frame.
right, on a lower time frame it did, you know what I'm saying? But on this chart, for instance, but it didn't. Now, like I said, I still want to see one more push up, a strong push up, but I don't expect it to close above this high. Now, let's look at a lower time frame. Let's look at the 15-minute chart because we'll look at what Brian said. It did close up there. This is went up there, minute chart or 5 minute probably closed up there. Pinned, came down. Now, this is a better look at something. So I see this move right here. Now, this is a B, C move, right? If we fibbed in our entry zone, get off of there. It's already been in our entry zone once. I want to see it come up. It's broke this trend line. It could come up back into our entry zone, follow the bottom of this trend line and trend kind of up. As long as it's closing up below that daily structure, guys, you're still looking short, because what did the momentum or the trend from the daily chart show us or tell us? The bulls were dying. So you want to be kind of on the short side, right? That's what all this is. It takes out all type of guessing, guys, like what you want to do. We already know we want to look for a short opportunity. ABC retracement, change of momentum. Now we look for ABC retracement to this high or maybe even up here for our entry to get in. But now it's just all about timing, right? And it's not the time for it to show that just yet. All that will happen in between, like I said, 10, 10:30 and London Open.
Wait, this one, you're saying that there's an ABC retracement right now?
Yeah.
Oh.
Well, you got the impulse move right here. This move broke this structure. So you've got inside return, B, here's C.
The reverse one, yeah.
Yeah.
Mm.
You didn't see it like that, did you?
No, I did not.
Why not? So
I'm
here's a good way to look at retracements or ABC corrections, right? Whenever there's a big move like this or a trend, right, or a nice change in direction, any type of move always has a ABC correction to it, regardless if it's small like this.
If it breaks market structure, it always has that
ABC correction. Correct.
So you can see where he pointed out the.
Now, it's not always going to be like a perfect ABC. Like I said, the correction waves can be very complex. They can go all the way to like D, E, F, G and form like a wedge or a flag or a pennant, whatever you want to call it. Those are just complex retracements or corrections to the market.
Because if you go up into a higher time frame, it will be more of a ABC rejection.
Yeah, let me put this on there. Let's see what the hour says. Now, if we looked at this, move A, B, C. That's the whole move we were looking at. Let me get that off of there. Hold on. It's probably kind of cluttered for you. Zoom in. Now, from this high to this low, inside return, B move down, C. Look at all this price action at C. We've already got kind of some pushes that stalled out, an engulfing candle in our entry zone, which is what we want to see, that kind of broke this structure. These candles right here are retests to this right here, the structure that was broken. So remember I said a minimum of 3 candles on a break of structure? This one actually took 1, 2, 3, 4. Now you've got this right here and another engulfing that kind of broke this type of structure right here. 1, 2. Let's see if this third candle does. If this third candle comes like this and the fourth one shoots back up, you know, that's not a clean break of structure. We'll probably be heading up to test the bottom of this trend line, enter back into our entry zone for like a quote unquote double top or an M formation, right? And then you will get in. But again, the timing of it isn't right just yet.
And you didn't look at the RSI or the MACD yet.
I looked at the MACD on the daily chart, and then I did reference the RSI on this chart. Boom. So RSI, it's on the lower side, meaning exactly what I'm expecting to happen. I'm expecting one more push up, right? Expecting, since it's oversold, one more push up. When the RSI and this one more push up both are starting to reject and fail, your RSI should be up around this top level right here, which is a sell signal. So let price tell you that price is exhausting as a bull. We already know the bulls have basically died from the prior trend, right? Or the higher time frames trend, right? That's what's shown was by the MACD. We already identified we're entering on a C wave,
Right, right.
right, from a higher time frame. So now this is all your confluence, guys, that says, you know, you want to be looking for the short sell, right? That's what the system does for you guys. It helps you build that list of confluence and helps you understand what you're about to enter into. Now, I will say, since we got that structure off the daily chart, what type of trade are we entering? Either a position or a swing trade. Now, do you have to hold for that full order? No, but just know that's what potential type of trade it is. So RSI, again, it's kind of on the lower level. I'm not going to enter in short. I do again. This is Asian Tokyo session. Between now and the beginning, I would say between 10:30 and 2 o'clock or so, you should see a bull run up. If not, what will happen is it'll break this lever or break this level, which would complete an ABC correction from this trend right here. And then that push up, that impulse or that breakout up would be weak, okay? Or that vector candle will be weak, or not necessarily weak, but it will fail to break the high, especially this high, right? So this is the high, this is a lower high. ABC correction, one more impulse up, maybe test this area, and then go short. So once you see the 1 hour chart basically trending bullish on this on this chart tonight, if you guys want to watch it, just pay attention to what the RSI is telling you. And if it's leaving wicks towards the high in this zone or in this area, that's your entry. I mean, that's all I can give you on this chart right now, guys. Because I haven't really went over the timing of everything with you guys yet. I was going to say that for Thursday.
Can't teach it all in one class.
This was awesome. This was really very cool. Thank you, Corey.
You're very welcome, Miss Debbie. I'm glad I could help you. So I'm going to leave it off right there, guys, right? And then I'm going to open up the floor for any kind of questions because it actually has been almost 2 hours.
You want to stop the recording now or let the questions be on the recording?
Let the questions be on there.
All right, cool.
Yeah, it'll give you some more insight. Let's see here. You guys can unmute yourself if you want to.
I don't want to.
What do you think about it, Gunnar? I haven't heard you all night, man. What's going on?
My mind is blown, son. I'm just trying to piece all together. To be fair, I really got to listen to it again because it's kind of just overlapped each other, and I just kind of got lost. You know what I'm saying? Like everything put together in one time. It was just like then you just put it all into a moving cog. And I'm like, oh, hold up, what happened? You know what I'm saying? So I gotta like listen
Just
to it
over and over, man. That's it. Over and over. Learn just over and over, and it'll start to make sense. That's what's great about this is that you don't have to get it the first time around.
No, they're recorded.
Yeah. Well, I mean, and just stick. You know, you're just gonna learn more and more stuff, especially come October 1st. You know, but you're gonna keep learning and learning and learning. So it'll start to all start sinking in. You'll be like, oh shit, that's right. Oh shit, that's right too. So.
Oh man, straight up.
Yeah, it'll definitely start.
I can't wait.
It's like I said, man. I hope. Ooh! I think I got something hot. Plus, listen, guys. So after this course, I'm not gonna say after this course. It's probably gonna be a little minute before I release this material. but I think there's a way I can teach you guys to get. I'm not even going to tell you. Well, yeah, there's a way that I can teach you guys to get like very precise wick entries.
Yes, let's work it tonight.
But it involves institutional order flow and order blocks. Okay, and like I said, that's a deeper study after we get you guys understanding this crap. So, but it's all coming, guys.
Which we will get you there.
Oh no.
Corey.
Yes, sir.
I don't know if anyone has any direct questions about what we went over tonight. Me personally, I'm definitely just going to have to watch the video.
Yeah.
If you don't mind, I had texted you a little earlier today, kind of just about what Forex is. You said it's a centralized. I guess this may be more intro information that I never picked up.
So that's a good question. So I'm gonna actually repeat the question real quick, if you don't mind.
Okay.
So he asked me actually, is Forex good, even though they're talking, about a money shortage and maybe the dollar collapsing and things like that, right? Which is a very, very good question. And my response to him was that, even though the dollar is collapsing, Forex is never going to go away because it's not a centralized financial market. It's dealing with world economies, first of all. Secondly, if you're concerned about the value of the dollar, the brokers allow you to actually withdraw in cryptocurrency. So you can start doing that as well, right? Now, going on to that, what I do highly suggest you guys buy, if you do, if you do withdraw in crypto, go buy a ledger, a crypto ledger. It looks almost like a USB drive or USB memory drive, right?
Like a thumb drive.
Yeah, like a thumb drive, but it's a ledger that you keep your crypto on. So it's not really bro. Just trust me. Get one.
It's basically like a bank in your wallet, a wallet in your pocket.
Right.
Cold wallet is what it's called.
Yep.
Exactly. For your crypto.
It's called what?
A ledger. It's a crypto ledger.
A cold wallet.
Yeah.
Wallet. Yeah. I mean, they're not even expensive. But like I said, if you once you get big into this and you really start, withdrawing and you do it in crypto,
don't lose it.
Yeah, don't lose it. But that's a good safe way to go. I would say that.
That's like don't lose anything though,
Yeah.
Right, exactly. But going back to your question, no, there's no worries about, if we hit a recession, guys, we make money buying and selling. It doesn't matter.
We can make very good money if the U.S. economy crashes, which we don't want, but it's not like the stock market. You can make very good money if you know that the economy were to any economy were to crash.
Exactly.
Make good money on it.
Exactly. So
remember the break in what was it, the Swiss franc back in, was it 15?
It was, dude. That shit collapsed FXCM for a little bit actually.
Yeah, and
that's what's crazy.
Yeah. But yeah, you can definitely make money when economies collapse. I mean, when this pandemic hit in March,